Stop scrolling, I'm serious. If you clicked this because you saw silver breakout headlines today, I need you to hear one sentence before anything else. The market doesn't move on your excitement, it moves on your liquidity. And when you buy because the headline feels urgent, you're often not early. You're useful. Now look at what just happened. We ran straight into the same ceiling again. That $83 zone, that exact area where price gets brave for 5 minutes and then suddenly forgets how to breathe. And if you felt that drop in your stomach, you're not weak. You're human. Because the most brutal trades aren't the ones where you're wrong. They're the ones where you're right long term, but the short term is designed to humiliate you first. Here's the story in plain English. A bullish headline lights a match. Retail piles in. Price spikes into resistance. The people who were already positioned use that rush to exit or rebalance. And the moment the crowd feels maximum confidence, the rug gets yanked. That's not conspiracy. That's mechanics. That's how a large player sells without crashing the market before they're done selling. So today isn't just silver went down. Today was a test. It tested one thing. How many buyers exist above $80 when the market is no longer seducing them with hype? And the answer, at least for now, is not enough to chew through the supply sitting at $83. This is where the comment war starts, because half of you are going to say double top, game over, and the other half are going to say bear trap loading zone. Good. I want that debate in the comments because it forces you to pick a timeline. Are you trading the next 48 hours or are you stacking the next 48 months? Because those are two different games with two different emotions. Let's break down the psychological trap that hit so many people today. You saw a bullish target. You saw a clean push upward. You saw the crowd celebrating, this is it. And your brain did what brains do. It tried to avoid regret. It said, if I don't buy now, I'll miss the move. That's not stupidity, that's survival wiring. But markets exploit survival wiring. They punish urgency, they reward patience. So in this emergency breakdown, we're going to do 4 things. We're going to dissect the rejection at $83 and why it matters. We're going to talk about the so-called double top and what it really means in a high volatility bull phase. We're going to map the danger zone under price, the levels that matter if this turns into a deeper flush. And then we're going to finish with a plan, not financial advice, a plan for staying rational when price is trying to make you emotional. Before we go deeper, drop a comment with one word. Stack or trade. No explanations. Just one word. I want to see what this audience actually is, because the way you interpret today depends on that single choice. All right, let's talk about the $83 ceiling and why it keeps slamming shut. People always ask, why do banks and analysts publish bullish notes right when price is stretched? They think it's because the analyst knows something magical. Sometimes they do. But more often, it's because headlines don't exist to inform you. They exist to move you. They create flow. Flow creates liquidity. And liquidity is how big positions get moved without leaving fingerprints. Imagine you're sitting on a massive winning trade. You bought much lower. Now price is high. You want to take profit or adjust risk. But if you sell all at once, you smash price and you sell into your own collapse. So you need buyers. You need lots of them. You need enthusiastic buyers who don't negotiate. They don't wait. They hit market buy. They chase. That is why the most confident headlines often show up at the most dangerous moments. Not because the thesis is fake, but because the timing is weaponized. And here's the part that makes people angry, but it's true. The market loves 2 types of people. The person who panics out of a good position and the person who panics into a bad entry. Why? Because both are emotional. Both are predictable. And predictable money is harvestable money. Now zoom out to the chart story. Price rejected near $83 before, and it rejected near $83 again. That's why the word double top is trending. A double top looks like an M, 2 peaks, 2 failures. A pattern that screams, buyers are exhausted. And if you learned technical analysis from textbooks, you're thinking the next move is straight down to the neckline. But here's what textbooks don't tell you loudly enough. In a fast bull phase, classic reversal patterns are constantly used as bait. They are real patterns, but they're also psychological landmarks. That means if everyone sees the same M, the market knows where their stop losses are. It knows where their fear is stored. It knows exactly how to press the bruise. So yes, a double top can be bearish, but a double top can also be a pressure cooker. It can be the handle forming before the breakout. It can be the market stalling, absorbing supply, then ripping through the level once sellers run out of ammo. This is why today matters. We didn't just drop. Now I want you to think like a market operator for 10 seconds. What would you do if you wanted to accumulate more without paying higher prices? You would scare people out. You'd create a sharp red candle. You'd let social media scream, top is in. You'd make weak hands hit sell. Then you quietly buy what they just threw away. That's not a guarantee that it's happening. But it is the incentive structure. And markets follow incentives like water follows gravity. So here's the core question for this entire video. Is today a warning that the rally is failing? Or is today the shakeout candles the word that bull markets use to clean the passenger seats before the next leg up? Hold that thought, because next we're going to put numbers on the battlefield. We're going to mark the levels that matter. And we're going to talk about what would actually confirm disaster versus healthy reset. Let's get practical. The internet loves drama. But price doesn't care about drama. Price cares about levels. And right now there are 3 zones you should be watching like a hawk. Zone 1 is the ceiling, the $83 area. This is the line everyone is staring at. It's where price got rejected. It's where confidence dies. It is also where the next big breakout would be confirmed if we ever close decisively above it and hold. Zone 2 is the current floor area around the upper 70s. This is where the market is deciding if today was just a flush or the start of a breakdown. When price snaps down and then sticks, that stickiness matters. A fast drop with no follow-through can be a signal of absorption. It can mean sellers hit and buyers quietly took the other side. Zone 3 is the real line in the sand around the mid-70s. This is where the narrative changes. If price loses that zone and can't reclaim it, then the breakout attempt looks more like a failed move. And failed moves can unwind fast because trapped buyers turn into forced sellers. Now hear me clearly. I'm not telling you what will happen. I'm telling you what matters if it happens. That's how you stay sane. You don't predict, you prepare. Because the biggest mistake people make after a day like today is this. They zoom in emotionally and zoom out financially. They stare at the red candle like it's a verdict on their future. And then they make a permanent decision based on a temporary feeling. If you are a trader, this is a different conversation. You need rules. You need risk limits. You need to accept that the market can be irrational longer than your leverage can stay alive. And leverage is where today did the most damage. Because a 3% move is nothing for a long-term holder. But for a leveraged chaser, it's a guillotine. If you are a holder, a stacker, or someone building a position, this is where you have to separate noise from signal. A violent intraday flush can be meaningless if the bigger structure holds. A weekly close can matter more than a 1-hour candle. And that's why the next couple of sessions are going to be critical for sentiment. Now let S talk about the most dangerous thing on days like today. The story your brain invents. You'll tell yourself, I always buy the top, or the market is rigged, or I should have sold, or I'm a genius for not buying. All of those stories are emotional shortcuts. They feel true because they protect your ego. They do not help you make money. Here is the only story that helps. Today was a volatility event. That's it. A volatility event designed to transfer metal from impatient hands to patient hands. And if that sentence annoys you, good. That annoyance is exactly what the market feeds on. Now I promised I'd provoke comments. So here is a simple question that splits the room. Do you think 83 is a wall that will hold for weeks, or a door that will break the moment sellers get exhausted? Write wall or door in the comments. No essays, just wall or door. All right. Now, for the part everyone actually needs, what do you do with this information without getting chopped to pieces by the next candle? Let's talk survival. Not survival like the world ends. Survival like keeping your brain intact while price tries to hijack it. Because in markets, the real battle isn't chart versus chart. It's your nervous system versus your impulses. First rule, stop treating headlines like signals. Headlines are often late. They're often simplified. They're often designed to move you, not guide you. If you buy because of a headline, you're usually buying after the move has already begun. And the market loves handing you excitement right before it hands you pain. Second rule, match your timeline to your tool. If you believe in a long-term thesis, you need long-term capital. That means you don't size a long-term belief with short-term fragility. You don't let a $2 move decide your life. If you can't hold through volatility, you don't own an investment. You own a stress subscription. Third rule, identify your decision level in advance, not the level you hope for, the level that changes the structure for you. That way, you aren't making decisions in the middle of a red candle with adrenaline in your hands. Fourth rule, accept that you will not buy the exact bottom. You will not sell the exact top. Perfection is the religion that keeps retail poor. The goal is not perfect entries. The goal is a process that keeps you in the game long enough for probabilities to work. Now here's what I'm watching going forward. I'm watching whether price stabilizes after this flush. I'm watching whether dips get bought without panic. I'm watching whether the market can build energy under the ceiling instead of just slamming into it and dying. And I'm watching the weekly close because the weekly candle is where a lot of bigger players take their cues. If we stabilize and hold key support, this entire day becomes a footnote, a scare tactic, a shakeout. If we fail to hold and we bleed lower, then yes, the double top crowd gets louder and the downside targets become real possibilities. But either way, Here I would ask the truth I want you to remember. Today did not prove anything about your intelligence. It only revealed your time frame. If you feel destroyed by today, you were overexposed to short-term noise. If you feel calm, you built your position like an adult. And now I'll end this video the way I started it, with honesty. If you bought the top today, I'm not here to shame you. I'm here to make sure you learn from it, because the market will run this play again and again and again. The only question is whether you'll keep donating liquidity or whether you'll start demanding better terms. So tell me in the comments, did today change your conviction or did it strengthen it? Write conviction up or conviction down. And if you want a follow-up video tomorrow, mapping the exact levels with a clean plan, write part 2 in the comments and I'll make it. Subscribe if you want real talk without the hype. And remember, in a bull market, the market's job is not to reward you, it's to test you.